Our opening speaker today is Dr. Annie Katchova to give us the Farm Income Outlook. Dr. Katchova serves as an associate professor and Farm Income Enhancement Chair in AEDE, where her research, teaching, and outreach cover topics related to agricultural finance, agribusiness management, and marketing and applied economics. She has presented topics related to farm income at the USDA Ag Outlook Forum in DC, the Chicago and Kansas City Federal Reserve Banks, and the national meeting of the Agricultural and Applied Economic Association. Just last year, she chaired a review panel of the USDA Economic Research Farm Income and Wealth Forecast Program that provides a comprehensive overview of the financial characteristics and performance of U.S. farm sectors and farm businesses. Dr. Katchova has received several nationally recognized awards and has served as the agricultural economics industry through a variety of positions. Probably the most unique title is that she holds the honorary title of Kentucky Colonel for her work as a faculty member at the University of Kentucky prior to coming to Ohio State. Her and her team have been active in the current agricultural use value forecast for Ohio's property taxes, as well as monitoring bankruptcies in Ohio and across the US. Please help me in welcoming Dr. Annie Katchova.
Well, good morning, everyone. I'm very glad to be here, and thank you all for coming, especially in this difficult driving conditions this morning. As the opening speaker today, I will talk a little bit about farm financial conditions and outlook, both for the U.S. and for Ohio. And before I start my presentation, I would like to thank my graduate research assistant, Siddhartha Bora, and my postdoctoral researcher, Bob Dinterman, who is sitting over there. And they're part of my team, and much of the presentation today is based on the research and outreach we have done over the last few years. So as a very quick overview of some of the themes that I will talk about today, and Bailey started the opening with kind of like an overview of the current farm economy situation. I will talk about farm income and assets today, and I will provide an overview of the USDA forecast that we have for 2019, in which we're expecting to see an increase for a third year in a row. And I will talk about the different components of farm income, particularly about the cash receipts that we're expecting to see from crops, and also about the government payments and farm-related income, how they compare to previous years. Then I will switch to farmland markets and talk about both land values and cash rents that we see here in Ohio, in the Midwest, and more generally in the US. And I will also touch base on the CAUV values and the tax for agricultural lands in Ohio, and some good news that I will present here. And finally, I will talk about financial stress, which is looking at the ag loan delinquency rates and bankruptcy rates for Ohio and the US, which have remained still at historic low rates, even though we see some recent upticks. So let's start with the USDA Economic Research Forecast on the net farm income and net cash income for 2019. So we expect to see a 7.3% increase in net cash income and 4.8% increase in net farm income for 2019. So I'd like to say that this is still a forecast for 2019, and the final estimates are going to be available next August. So we're still in a forecast kind of stage. So again, that would mark a third consecutive year in a row of farm income increases. If we look at Ohio, the data ends in 2018, as USDA does not provide an official forecast for Ohio until next August. So last year we had a second consecutive year of increased farm incomes. And since we look at these trends, both for Ohio and for US farm incomes, they follow each other pretty closely, except that Ohio's farm income seems to be a little bit more volatile than the US farm income. But if historic trends are to repeat again, we should perhaps expect to see also farm incomes for Ohio farmers increasing this year as well. So if we take a long-term view, this is the 70-year average for Ohio and US farm incomes. The last 3 years, we were below the historic trends. However, if these values are realized for 2019, we would be right at the long-term average. So we would have recouped some of the losses that we have seen since 2013. But again, this year won't be one of the best we have seen on record either. One thing to mention is that we are talking about forecasts and not estimates, so a lot can change over time. And some of the research that I have done this year while I was chairing the USDA review panel to review how these farm income forecasts and estimates are done, we looked into the accuracy of these forecasts. So one thing that we found is particularly the February forecast underpredicts farm income by about 10%. And so that's why earlier this year we were talking that perhaps the economy wouldn't be doing very well this year. And those forecasts were a little bit more optimistic as August came about. So one thing we have found is that these forecasts get more accurate over time. And so that error in the forecast gets reduced. And in a recent study that I have done with Siddhartha Bora and a colleague at Purdue, we found that even though USDA may underpredict, that actually could be a rational behavior by USDA if the cost for overprediction is higher than the cost for underprediction. So now looking at the components of farm income and how they kind of come to the total, to the bottom line of net farm income and net cash income, the first thing we're going to look at is cash receipts. So for 2019, the USDA forecast gives a little bit lower prediction for crop receipts and just a slightly bit higher prediction for livestock receipts as compared to last year. If we look at the different commodities as far as cash receipts, for corn, we're expecting very similar receipts as last year. But for soybeans, we see a significantly lower cash receipts being forecasted for this year as compared to last year. That's again at the US level. And if we look at Ohio, the last data that we have is from 2018. And again, Ohio is tracking the US trends pretty well in terms of corn and soybean receipts. So if we look at the Ohio cash receipts for soybeans versus the US cash receipts for soybeans, you can see very, very similar trends over time. So again, if the forecast is for a reduction in the cash receipts for soybeans for this year for the US, perhaps we should expect the same reduction for soybean receipts in Ohio for 2019. Again, there is no official USDA forecast for 2019. If we look at corn cash receipts, there's again just flat to slight decline in corn receipts. So again, if historic trends continue, perhaps we can see the same trends here in Ohio. If we take a look at farm expenses, USDA is forecasting to see an increase slightly in nominal terms. So particularly that would be coming from labor and feed expenses, which are expected to increase. But we also expect to see some reduction in interest, seed, and fuel expenses. So finally, thinking about total direct government payments, both for the US and Ohio, we see a significant increase in government payments for this year. And again, most of them are coming from the market facilitation program, which are expected to increase more than 100%. So to $10.7 billion for 2019, which would make the total amount of government payments forecasted 19.5 billion for 2019 for the US. So here's a chart thinking about how we're going to get to net farm income for this year, 2019, as compared to 2018. So if we start with 2018, right here at $84 billion, we see that cash receipts and cash for crops and crop inventories are forecast to go down, with slight increase for livestock receipts. And also we see some modest increases in expenses. But the biggest compensation is actually coming from both government payments, direct government payments, and as well as farm-related income. So this farm-related income includes crop insurance payments, including the preventive planting payments that would come in here. So as we're seeing from this year, even though we're expecting to see a 4.8% increase in farm incomes, most of it is going to come from government payments and other farm-related payments at the expense of having lower crop cash receipts. So we basically have a redistribution in the components of where income is going to come from this year. So this was the farm income situation. If we look at the balance sheets of the farm sector, we see increases in all categories of farm debt, farm equity, and total farm assets. So these are the percent changes from the previous year, and we're again seeing debt growing at 3.4%. So positive growth in debt. The bad news is that it is still outpacing the growth in both assets and equity. The good news is that assets and equity are actually growing this year, and even though very, very modestly at the pace of inflation. So if we look at how farm assets are distributed, 83% of them are coming from real estate assets such as farmland, and they're expected to increase 1.9% in 2019. So now switching to this most important asset in agriculture, which is farmland. Looking at the 2019 values for cropland values from the US, we are seeing increases by 1.2% from last year. So as we are coming out of kind of difficult times in some reductions in land values and staying flat for a few years, we are seeing slight positive changes in land values in the US. As far as Ohio, very similar trends for this year. Cropland values increased by 1.3% in 2019 from last year. And so again, that is a positive trend. If we look at the distribution of cropland values around the US, we see that typically the cropland values around the Midwest are much higher and than most of the rest of the country. So here in Ohio, we're standing at $6,400 per acre for cropland. And these are the percent changes from last year. At Ohio, we have a 1.3% change in cropland values. And again, if you look at these trends, Ohio is doing better than most of the other Midwest states. So I would characterize this as having strong farmland markets here in Ohio that are really holding their value very well. And that's what has helped Ohio farmers kind of overcome these difficult last few years. If we take a turn to US cash rents, you can see that they're increased by 1.4% this year. And we did see some reduction in cash rents for US in 2016. Whereas if we look at the Ohio cash rents, we see much flatter lines. We did not see any of the reductions that the US experienced over the last few years. So again, we have comparatively high cash rents, and similar to some of the other states in the Midwest. Here we have $155 per acre for cash rent for Ohio cropland. So in terms of percent changes from last year, Ohio is gaining 2% in cash rents. And again, that is much better than the other Midwest states that we're seeing here. So again, very strong market. If we compare cash rents and cropland values for Ohio and the US, they're very, very similar trends for cropland value. But the one surprising thing that we're seeing here is, again, that drop in cash rents in the US that we saw a few years back, we have not experienced that in Ohio. Like cash rents remained either the same or kept increasing over the last few years. And the final point that I have on farmland markets is Bob Dinterman and I have done a lot of research on the current agriculture use value program, which is a tax program for Ohio farmland that taxes the farmland based on the agriculture use rather than the market value. And it's a formula that is based on net operating income from corn, soybeans, and wheat. And we also see that low interest rates and high commodity prices were the largest factors for recent increases, which prompted some changes in the formula. So our team is putting up projections for next year for CAUV values. So you can see the official estimates, of course, from the Ohio Department of Taxation. Our team is putting projections for the future. So we're predicting that if we plug all the historical data to see a 28% decline in CAUV values for 2020 as compared to 2019. And that would imply that we would see 5th and 6th consecutive year of declines in CAUV values. Now, this would reduce pressure on cash rents in Ohio. And one of the studies that we had with Bob Dinterman shows that in a situation where landowners are renting land to tenants, we see that about 30 to 40% of the tax gets transferred from the landowner to the renter in form of higher cash rents. So that burden of the tax gets shared between a landowner and a renter in case the land is rented. So these are our forecasts and predictions for the CAUV values for cropland in Ohio. So we see that those forecasts are, those values are differing based on the soil productivity. So higher soil productivity of the land means higher CAUV values. And since 2015, we have seen reduction in CAUV values. Again, expecting 28% decline for next year. And most of this decline is because the phase-in would no longer be present. So again, this is some good news as far as lower taxes for farmland in Ohio predicted for next year. Again, most of these property taxes, they're on the assessed value. As far as the trends, most of these trends are coming from the assessed values of land as opposed to the assessed values of buildings, which seem to be a lot more stable. So now turning to farm financial stress, and we are measuring two indicators. One of them is ag loans delinquency rates in the US. So here's a map of the US. Data comes from FDIC, and the dots in this map are where the loans are located, and the shades of the states are where those delinquencies are happening. So we see a really high concentration of agricultural loans in the Midwest, but generally the Midwest has relatively low agricultural loan delinquency rates. So currently the delinquency rate over the last year has been about 2.05%. So if we increase that map and look at Ohio in particular, again, the dots are where the loans are located, whereas the shading is the delinquency rates for agricultural loans. So the Ohio ag loan delinquency rates was 1.59% in the last 4 quarters. So this is below the US average. But again, we have some pockets of increased delinquencies across Ohio. Now switching to Chapter 12, bankruptcies. As far as total bankruptcy files, we had an increase in the debt limit this year to $10 million in debt as far as who's qualified to file for bankruptcies. So there were 583 bankruptcies filed during the last year. And most of them are in the Midwest states that are concentrated in dairy, such as Wisconsin and Minnesota, or states that have had declining land values in the past, such as Kansas and Nebraska. So in terms of bankruptcy rates for Ohio and the US, these are the number of Chapter 12 filings per 10,000 farmers. In the US, we're looking at 2.18, whereas in Ohio, this is 0.93. So we have 0.93 Chapter 12 filings per 10,000 farms in Ohio. This has been historically very stable. Ohio's rate is about half of the US rate. So just to summarize some of the themes that I talked about today, farm incomes are forecast to grow for a 3rd consecutive year in a row. And so the farm economy may be showing some sign of recovery since the agricultural downturn started in 2013. But this recovery has been slow, especially early this year. Again, the forecast was much more pessimistic. So farm incomes still remain below the historic highs of 2013, although again, we are seeing that maybe they are approaching their long-term average. And what is different about this year is, again, where farm incomes are coming from. As we're expecting to see lower crop cash receipts, we're expecting to see higher government payments and farm-related income. So that is also different this year. Strength in farmland markets has helped, particularly with cropland values and cash rents remaining strong. They're going at the pace of inflation for US and Ohio, which again is relatively good news given the struggles that we had over the last few years. We also projecting expected declines in CAUV values and the property tax for 2020. That will definitely help farm incomes in Ohio and not put upward pressure on cash rents in Ohio. And farmers are experiencing financial stress as indicated by delinquencies on loans and bankruptcies, but that is still at historic lows for agriculture. And I'd like to say that even though on average things may look okay, there is still financial stress that is being experienced by some farmers, particularly those that carry high debt levels. But overall, we probably don't expect to see many increases to farm financial stress over the next year. Of course, that all of this is contingent on the trade negotiations, and that would kind of bring us to the topic of the next speaker. So with that said, I'd like to thank you for coming, and if there are any questions. Yes.
I mean, the 6-year decline in CAUV value, why is it then that land prices, if that CAUV is based on earnings of farmers, why is it that the land prices are not following suit?
Yes. So the question again, to repeat for the record, is if we have seen CAUV values coming down for 6 years in a row, why didn't the land values come down over the last few years? So again, the land values, first of all, there are two factors affecting land values. One of them is the agricultural use in land values. The second one is just also use of land for other purposes, such as development purposes, or if it's being close to, you know, big population centers and things like that. So the total value for farmland is contingent on these factors, whereas CAUV values only consider the value of agriculture when predicting those values. And another thing to say about CAUV values is they're using historical formula that is coming from the last 7 to 10 years. And so it's not representing the state of the economy currently, but the state of the economy in the past few years. So we've had, in the past few years, we've had very, very high prices and yields in that formula that were coming from 2013. So as time went on and these high values were rolling off that formula, that also what's precipitated that decline in the CAUV values. And again, the strong, you know, the strong trend in increasing farmland values in general in Ohio is also due to the fact that, you know, we do see some recovery in farm incomes currently, and so that's also helping farmland values as well. Any other questions?
Quick follow-up on that answer. So you mentioned there's two factors that drive land value prices. Basically, agricultural use of land and potential. If CAU is going down, does that mean the total value of land is increasing mainly because of those non-agricultural uses? Essentially development. Is that true? You have a slide where it's very visible values across the state. Is that generally true for Ohio or is it true across the state?
Yeah, I personally, so the question is here, what is kind of pushing up the land values in Ohio as well as across the US? And again, this, there are several factors for that. I have not personally done research on, you know, what part is due to which of the factors, the agricultural or the residential use factor. Again, I would expect that for land values, thinking especially what caused the the crisis in the 80s as far as dropping land values is also what we saw earlier in 2013, right? We were coming from really strong farm incomes, really good economy, and then all of a sudden those incomes started coming down. And so another factor that is in consideration is also the debt that is being carried for farmland. And so one thing we saw in the 80s is that as farming incomes came down, it was very hard to refinance those loans on farmland values, on farmland. And so what happened was there was a lot of inflow of land on the market. And so as you know, land is not very much transacted on a year-to-year basis. And so when we see a lot more land available for sales, that's kind of like what dropped the farmland values. So what didn't happen during those last 6 years when we were in a period of agricultural downturn, as opposed to the crisis of the 80s, is that even though farm incomes were much lower, what we did not see is farmers not being able to service their loans and put that farmland on the market, and that to cause that kind of rapid decline in land value. So I would also attribute that to kind of having farmland values being stable or slightly increasing in the last 6 years.